There's a metal sitting quietly in the shadows of global finance right now. A metal that has served as money for over 5,000 years. A metal that powers the technologies reshaping our world. A metal that institutional investors have largely ignored for decades. And that metal is silver. What I am about to share with you over the next 25 minutes is not speculation. It is not hype. It is a careful examination of converging forces that suggest silver may be approaching one of the most significant inflection points in modern financial history. But here is what concerns me most. The majority of investors are not paying attention. They are focused on artificial intelligence stocks. They are watching cryptocurrency fluctuations. They are debating whether central banks will cut interest rates next quarter. And while they are looking in those directions, something remarkable is developing in a market that most have dismissed as a relic of a bygone era. I want to be clear from the outset. I'm not here to tell you that silver will make you wealthy overnight. I'm not here to provide specific price predictions. And I'm certainly not here to encourage reckless speculation. What I am here to do is serve as your guide through a complex landscape, to help you understand the fundamental forces at play, to prepare you mentally and strategically for what may unfold, and most importantly, to ensure that whatever decisions you make them from a position of knowledge rather than emotion. So let us begin. Before we examine the current situation, we must first understand what makes silver unlike virtually any other asset in the world. Silver occupies a peculiar space in the financial ecosystem. It is simultaneously a monetary metal with a history stretching back to ancient civilizations, and an industrial commodity essential to modern technology. This dual nature creates dynamics that few other assets possess. Consider gold for a moment. Gold is primarily a monetary metal. Yes, it has some industrial applications, but the vast majority of gold demand comes from investment and jewelry. This makes gold relatively straightforward to analyze. When investors seek safety or inflation protection, gold typically responds. Silver is different. Silver must satisfy two masters. On one hand, it responds to the same monetary forces that drive gold. When confidence in fiat currencies wavers, when inflation erodes purchasing power, when geopolitical tensions rise, silver benefits from its historical role as real money. On the other hand, silver is consumed by industry at an extraordinary rate. It is used in solar panels. It is essential for electric vehicles. It appears in smartphones, medical devices, water purification systems, and countless other applications. Unlike gold, which is largely hoarded and recycled, silver is often used in such small quantities that recovery is economically unfeasible. This creates a fascinating tension. When economic conditions are poor, industrial demand for silver typically declines. But monetary demand often increases during these same periods as investors seek protection. Conversely, during economic expansions, industrial demand surges even as investment demand may wane. Understanding this duality is crucial because we are now entering a period where both forms of demand may align simultaneously. And this, historically, is when silver produces its most dramatic moves. Let me share something that should concern every serious investor. For the past several years, the silver market has been running a structural deficit. This means that total demand has exceeded total supply from mining and recycling. The gap has been filled by drawing down existing inventories, stockpiles that have accumulated over decades. Now, ask yourself a simple question. What happens when you continuously withdraw from a finite pool without adequate replenishment? Eventually, the pool runs dry. The silver mining industry faces significant challenges. Unlike gold, where major discoveries and new projects continue to emerge, silver production has largely stagnated. The majority of silver produced globally comes not from primary silver mines, but as a byproduct of mining other metals, particularly lead, zinc, and copper. This means silver supply is somewhat inelastic. Even if prices rise substantially, silver production cannot respond quickly because miners cannot simply decide to produce more silver. They would need to increase production of the base metals that silver accompanies, and those decisions are driven by entirely different market forces. Meanwhile, demand is accelerating. The global push toward renewable energy has placed silver at the center of one of the largest industrial transformations in human history. Solar panel manufacturing consumed approximately 140 million ounces of silver in 2022. By some estimates, this could rise to 300 million ounces or more annually by the end of this decade. Electric vehicles contain significantly more silver than traditional automobiles. The fifth-generation wireless infrastructure being deployed globally requires silver. Data centers, artificial intelligence systems, and advanced electronics all depend on silver's unique properties, particularly its unmatched electrical and thermal conductivity. Do you see the problem emerging? We have stagnant supply meeting exponentially growing industrial demand, occurring at precisely the moment when monetary demand may be awakening due to macroeconomic pressures. This is not a situation that can persist indefinitely. Something must give. To understand where we may be heading, we must examine where we have been. Silver markets move in cycles, and these cycles tend to be long and dramatic. Unlike stocks, which often climb steadily over time, silver can remain dormant for years before experiencing explosive moves that compress decades of gains into brief periods. Consider the 1970s. After being suppressed at artificially low prices for decades, silver exploded from under $2 per ounce in 1971 to nearly $50 per ounce in 1980. This was not a gradual appreciation. It was a violent repricing that caught most investors completely off guard. Then came a long bear market. Silver declined for 20 years, falling back to single digits, and remaining there as the world focused on technology stocks, real estate, and other seemingly more exciting opportunities. In 2001, silver began another bull market. It rose from around $4 per ounce to nearly $50 by 2011, once again approaching that 1980 high. Those who recognized the cycle early and maintained discipline through volatility saw extraordinary returns. Those who arrived late, buying near the peak in a frenzy of excitement, suffered painful losses. Since 2011, silver has been range-bound, trading mostly between $14 and $30 per ounce. This extended consolidation has caused most investors to lose interest entirely. Silver has become, in many circles, almost a punchline, a metal that seems perpetually poised to move but never does. But here is what experienced cycle analysts understand. The length of a consolidation often correlates with the magnitude of the eventual breakout. The longer a market compresses, building tension, the more explosive the eventual release tends to be. We are now more than a decade into this consolidation. The fundamental case has strengthened dramatically during this period, and the technical setup for those who study such patterns suggests major resistance levels are being tested. Does this guarantee an imminent surge? Absolutely not. Markets can remain irrational longer than any of us can remain patient. But the historical pattern suggests vigilance is warranted. No asset exists in isolation. To understand silver's potential, we must understand the broader economic environment in which it operates. Central banks around the world have engaged in unprecedented monetary expansion over the past 15 years. Balance sheets that were measured in hundreds of billions of dollars before 2008 have swelled into the trillions. Interest rates were suppressed at or near zero for extended periods. Despite recent tightening efforts, the structural debt burdens of major economies have only grown larger. What does this mean for silver? Throughout history, precious metals have served as a barometer of confidence in monetary systems. When faith in central bank management is high, when inflation is controlled, when currencies maintain their purchasing power, precious metals tend to languish. Why hold an inert metal when paper assets are performing well? But when cracks appear in that confidence, when inflation becomes persistent, when debt burdens begin to feel unsustainable, precious metals tend to reassert their ancient role as stores of value. Look at the signals emerging in the current environment. Despite aggressive interest rate increases, inflation in many developed economies has proven stubbornly persistent. Government deficits continue to expand even during periods of economic growth, suggesting structural imbalances that will only worsen during the next recession. Geopolitical fragmentation is accelerating, with nations increasingly questioning the reliability of dollar-based reserves and seeking alternatives. Central banks themselves are accumulating gold at the fastest pace in decades. These institutions, with their vast resources and sophisticated analysis, are quietly repositioning. Silver typically lags gold in the early stages of precious metal bull markets, but when momentum shifts, silver often outperforms dramatically. The gold-to-silver ratio, which measures how many ounces of silver equal 1 ounce of gold, currently sits at historically elevated levels. In the past, extremes in this ratio have preceded significant silver outperformance. This does not mean silver will definitely rise. Macroeconomic forces are complex, and outcomes are never certain. But the backdrop is becoming increasingly favorable for assets that benefit from monetary instability. Here is something I want you to think deeply about. At the beginning of every major market move, the vast majority of participants are positioned incorrectly. This is not a flaw in the system. It is the system. Markets move when positioning is lopsided, when sentiment reaches extremes, when the crowd has convinced itself that a particular outcome is certain. Where is sentiment towards silver today? After more than a decade of disappointment, most investors have abandoned silver entirely. Financial advisors rarely recommend it. Media coverage is minimal. The professional investment community views silver, at best, as an industrial commodity play and, at worst, as a speculative relic favored by fringe enthusiasts. This widespread dismissal is not evidence against silver. In the counterintuitive logic of markets, it may be evidence in favor of it. Think about how markets actually work. When everyone is bullish on an asset, when every portfolio already holds it, when every positive scenario is priced in, who remains to buy? The answer is virtually no one. This is why assets crash from peaks despite seemingly perfect fundamentals. Conversely, when everyone has given up on an asset, when portfolios are empty, When negative sentiment has become consensus, who remains to sell? Very few. And this creates the conditions for upside surprises. I am not suggesting you should buy silver simply because it is unpopular. Contrarian investing for its own sake is not a strategy. But I am suggesting that the current positioning provides the raw material for significant moves, if fundamentals align. And as we have discussed, the fundamental picture is strengthening precisely as sentiment remains depressed. Let us now turn to practical considerations. I want to address two distinct audiences: those who already hold silver and those considering an initial position. If you currently own silver, whether in physical form, through exchange-traded funds, or via mining shares, you face a particular set of challenges. The first challenge is patience. You may have held silver for years, watching it move sideways while other assets appreciated. The temptation to sell in frustration is real. Every financial commentator dismissing silver feels like validation for those doubts. Every day the price fails to move confirms the narrative that you made a mistake. But ask yourself, has your original thesis changed? If you bought silver based on supply and demand fundamentals, those fundamentals have only strengthened. If you bought based on monetary policy concerns, those concerns have only intensified. If you bought as insurance against systemic risk, that risk has not diminished. Selling an asset because you're tired of waiting is an emotional decision, not a rational one. The market does not care about your timeline. It moves when conditions are right, not when your patience expires. The second challenge is position sizing. If your silver allocation has become uncomfortably large relative to your total portfolio, if it represents so much of your net worth that price fluctuations cause genuine anxiety, then adjustments may be appropriate. No single asset, regardless of potential, should dominate a prudent investor's holdings. But if your position is sized appropriately, if you can hold through volatility without making impulsive decisions, then patience may be your greatest asset. The third challenge is managing expectations. Even if silver performs well from here, the path will not be smooth. There will be sharp corrections that test your conviction. There will be periods where silver declines while other assets rise, making you question everything. There will be moments of extreme volatility in both directions. Your job as a holder is not to predict these movements. Your job is to ensure your position size allows you to remain rational regardless of what occurs. If you cannot sleep at night because of your silver holdings, your position is too large. Reduce it until you can think clearly. Finally, have an exit strategy. Not a price target necessarily, but conditions under which you would reduce or eliminate your position. Perhaps it is when the fundamental thesis changes. Perhaps it is when sentiment shifts from extreme pessimism to extreme optimism. Perhaps it is when your personal financial needs require liquidity. Whatever your criteria, define them now, while you can think objectively. Do not wait until markets are moving violently to make these decisions. Now, let me address those who do not currently hold silver, but are considering whether to establish a position. The first question you must ask is, why? This seems obvious, but is frequently overlooked. What role would silver play in your portfolio? Are you seeking inflation protection, industrial commodity exposure, speculation on price appreciation, insurance against monetary system stress? Your answer to this question determines everything else. It determines how much to allocate. It determines what form of silver ownership makes sense. It determines your time horizon and your tolerance for volatility. If you cannot articulate clearly why you're considering silver, you are not ready to buy. Go back to basics. Study, think. Only when you have a clear thesis should you consider committing capital. Assuming you have a defined purpose, the next consideration is allocation size. I want to be direct here. Silver is volatile. It can decline sharply and quickly. It can remain dormant for years. It pays no dividends. It generates no cash flow. It requires storage if held physically. It carries counterparty risk if held through financial instruments. For these reasons, silver should typically represent a modest allocation within a diversified portfolio. The specific percentage depends on your circumstances. But for most investors, something in the range of 5 to 15% of investable assets dedicated to precious metals collectively, with silver being a portion of that, represents a reasonable starting point. This may feel inadequate if you are convinced silver is about to surge. But remember, your goal is not to maximize returns from any single asset. Your goal is to build wealth sustainably over time, while managing risk appropriately. Outsized positions create outsized stress, and stress leads to poor decisions. Once you have determined an appropriate allocation, consider how to implement it. Physical silver in the form of coins and bars offers no counterparty risk. You own the metal directly, but it requires secure storage, incurs premiums over spot price when purchasing, and can be illiquid when selling. For those who prioritize absolute ownership and protection against systemic risk, physical silver has appeal. Exchange-traded funds and trusts offer convenience and liquidity. You can buy and sell easily through brokerage accounts. But you own shares in a fund, not silver directly, which introduces counterparty risk and trust in custodians. For those who want price exposure without logistical complexity, these instruments may be appropriate. Mining company shares offer leverage to silver prices. When silver rises, profitable mining companies often rise more. But they also carry business risk, management risk, and operational risk that pure metal exposure does not. For sophisticated investors willing to analyze individual companies, miners offer opportunities but also complexity. There is no universally correct answer. The right approach depends on your priorities, your expertise, and your circumstances. Finally, regardless of how you implement silver exposure, do not invest more than you can afford to lose. This is not mere disclaimer language. It is essential wisdom. Silver could decline significantly from here. It could stagnate for years longer. No investment is guaranteed. Only allocate capital that, if lost entirely, would not compromise your financial security or well-being. This discipline protects you from both financial ruin and emotional decision-making. I want to shift now to perhaps the most important section of our discussion. Regardless of whether you are an existing holder or a potential investor, there are behavioral errors that can devastate your results, even if your analysis is correct. Let me address these directly. Silver will test your emotions relentlessly. When prices rise sharply, euphoria will tempt you to buy more at precisely the wrong moment. When prices fall, fear will urge you to sell at the bottom. When prices stagnate, boredom will push you toward impulsive action. Successful investors are not those who eliminate emotions. They are those who recognize emotions and refuse to act on them. When you feel excited about buying, pause. When you feel panicked about selling, pause. The intensity of your emotion is often inversely correlated with the quality of the decision it suggests. Develop rules for yourself. Perhaps you wait 24 hours before acting on any impulse. Perhaps you require consultation with a trusted advisor before major moves. Whatever system works for you, implement it before you need it. Leverage is the destroyer of wealth in volatile markets. When you borrow to buy silver, whether through margin accounts, futures contracts, or leveraged funds, you introduce the possibility of being forced to sell at the worst possible moment. Markets can remain irrational longer than you can remain solvent. A temporary decline that a cash buyer can simply endure becomes a catastrophic liquidation for a leveraged buyer. You may be correct about direction and still lose everything because your timing was imperfect. For most individual investors, leverage in volatile assets like silver is inappropriate. The potential for enhanced returns is not worth the risk of forced liquidation. You will not call the exact bottom. You will not call the exact top. Accepting this reality is essential. Investors who attempt to time markets precisely typically underperform those who establish positions based on long-term thesis and maintain discipline through volatility. The energy spent trying to optimize entry and exit points is better spent ensuring your position size is appropriate and your thesis is sound. If silver appreciates significantly, it will not matter whether you bought at the absolute low. If silver declines significantly, it will not matter whether you avoided the absolute high. What matters is that your overall approach is rational. Capital allocated to silver is capital not allocated elsewhere. While you wait for silver to perform, other assets may appreciate. This opportunity cost is real and must be considered. This does not mean you should abandon silver to chase whatever is currently performing. Performance chasing is its own mistake, but it does mean you should honestly assess whether the potential returns from silver justify the opportunity cost relative to other options available to you. There is no shame in concluding that silver does not belong in your portfolio. Different investors have different needs, different time horizons, different risk tolerances. The goal is not to own silver. The goal is to build wealth. If silver does not serve that goal for you, do not force it. If you own silver or are considering buying, you will naturally gravitate toward information that supports your position. You will find the bullish analysts more credible. You will dismiss bearish arguments too quickly. You will interpret ambiguous information favorably. This is human nature, but it is dangerous. Actively seek out the strongest arguments against your position. Steelman, the bearish case. If your thesis cannot withstand serious criticism, it is not a thesis worth acting on. Silver is one asset within what should be a comprehensive financial plan. Do you have adequate emergency savings? Is your debt under control? Are you saving appropriately for retirement? Is your insurance coverage adequate? No investment thesis, however compelling, should distract you from financial fundamentals. If you are buying silver while carrying high-interest debt, you are almost certainly making a mistake. If you are buying silver instead of maintaining emergency reserves, you are creating fragility that may force you to sell at the worst time. Get your financial house in order first. Only then consider speculative positions. This may seem unusual to mention, but it is important. Some investors become so attached to an asset that it becomes part of their identity. They are not merely investors in silver, they are silver investors, defined by their position. This attachment creates psychological barriers to rational decision-making. Selling feels like betrayal. Acknowledging mistakes feels like personal failure. The investment becomes about being right rather than making money. Hold your positions loosely. Be willing to change your mind if evidence warrants. Never let any asset define who you are. I have spent considerable time discussing why silver may be approaching a significant moment. In the interest of balance and intellectual honesty, let me now discuss what could go wrong. The industrial demand thesis depends on continued growth in solar energy, electric vehicles, and advanced electronics. If technological development takes unexpected directions, if alternatives to silver-intensive technologies emerge, if economic growth falters and industrial activity declines, the demand picture could deteriorate. The monetary thesis depends on continued concerns about inflation, currency debasement, and financial system stability. If central banks successfully engineer soft landings, if inflation returns to target levels, if confidence in monetary management is restored, the urgency driving precious metal demand could fade. The supply thesis depends on continued constraints in silver production. If new mining projects come online, if recycling rates improve dramatically, if technological efficiency reduces silver usage per unit of production, the supply squeeze could ease. Moreover, even if the bullish thesis proves correct, timing remains uncertain. Markets can take far longer to recognize value than fundamentals suggest they should. You could be absolutely right about silver's eventual destination and still endure years of underperformance before that destination is reached. None of these risks invalidate the bullish case, but they remind us that investing is probabilistic, not deterministic. We are making bets based on incomplete information about an uncertain future. Humility about our limitations is not pessimism, it is realism. The foundation of risk management is position sizing. I have mentioned this repeatedly because it is the single most important factor in determining outcomes. An excellent investment with inappropriate sizing becomes a disaster. A mediocre investment with appropriate sizing becomes manageable. Before establishing any position, ask yourself, what is the maximum I can lose without compromising my financial security or psychological well-being? Your position size should ensure that even a total loss, though painful, would not derail your life. Beyond position sizing, diversification provides protection. Silver should not be your only hedge against monetary instability. It should not be your only exposure to commodities. It should not be your only investment. A portfolio that depends on any single asset performing is fragile. Consider time diversification as well. Rather than investing your entire allocation at once, consider building positions gradually over time. This approach sacrifices potential returns if prices rise immediately, but protects against the risk of terrible timing. Given the uncertainty inherent in any investment, this trade-off is often appropriate. Finally, maintain liquidity reserves outside of your silver position. Ensure you have cash or near-cash assets available for emergencies and opportunities. This prevents forced selling during temporary price declines and provides optionality if attractive opportunities arise elsewhere. Silver occupies a unique position in the financial ecosystem, serving simultaneously as a monetary metal and an industrial commodity. The supply-demand balance has tightened significantly, with structural deficits drawing down inventories that cannot be replenished quickly. Macroeconomic forces, including persistent inflation, unprecedented debt levels, and geopolitical fragmentation, create a backdrop favorable to monetary metals. Market sentiment towards silver remains depressed after a decade of disappointing performance, creating conditions where positive surprises could have outsized impact. None of this guarantees that silver will perform well. Markets are complex, and confident predictions are the domain of fools and charlatans. But the evidence suggests that thoughtful investors should at least consider silver's role in a diversified portfolio. If you already hold silver, the primary challenges are patience and position management. Ensure your allocation is appropriate for your circumstances. Have clear criteria for adjusting positions, and prepare psychologically for the volatility that will inevitably accompany any significant move. If you are considering silver, begin with clarity about purpose. Determine an appropriate allocation, choose an implementation method suited to your needs, and invest only capital you can afford to lose entirely. Regardless of your current position, avoid the behavioral errors that destroy returns even for investors with correct analysis. Manage emotions, avoid leverage. Accept that perfect timing is impossible. Consider opportunity costs honestly. Fight confirmation bias actively. Maintain perspective on your overall financial life. And never let any investment define your identity. We began this discussion with the observation that silver may be approaching a significant inflection point, while most investors remain unaware. Having examined the evidence, I believe this observation is defensible. The convergence of tightening supply, accelerating industrial demand, supportive macroeconomic conditions, and depressed sentiment creates unusual conditions. But I want to leave you with something more important than any market thesis. The purpose of investing is not to be right. It is not to prove yourself smarter than the market. It is not to accumulate bragging rights or validation. The purpose of investing is to build wealth that supports the life you want to live, to create security for yourself and those you love, to generate options and freedom, to reduce financial stress rather than increase it. No single investment, however promising, serves this purpose if it causes you to lie awake at night worrying. No market thesis, however sound, serves this purpose if it leads you to neglect fundamentals like emergency savings and debt management. No potential return, however attractive, serves this purpose if achieving it requires risking your financial security. Silver may indeed shock the markets. The forces we have discussed are real and significant. But whether silver rises, falls, or stagnates, your well-being depends far more on your behavior than on silver's behavior. Invest rationally. Manage risk prudently. Maintain perspective. And never forget that the goal is not to own silver or any other asset. The goal is to build a life worth living. Whatever you decide about silver, I hope this discussion has provided frameworks for thinking clearly about markets and your place within them. The specific opportunities change constantly. The principles of sound investing remain remarkably consistent. Stay disciplined, stay patient, stay rational, and whatever comes, be ready.